UCC Talk 24. Here on this channel, we're all about the UCC. Public and private rights, giving people information and knowledge to enrich themselves. So today I'm going to talk about the eligibility of consumer loans and finance company paper, right? That's 12 CFR, right? 201 104, right? So I'm all about negotiable instruments, right? And learn how to utilize them in transactions, right? But this particular one, a lot of people have talked about this though, but if you get a little deeper understanding, right? If you study the UCC and also the Bill of Exchange Act, right? You see in this blue area, right, that it says notes, drafts, and bills of exchange arising out of actual commercial transactions. That is, notes, drafts, and bills of exchange issued or drawn for agricultural, industrial, or commercial purposes, or the proceeds of which have been used or are to be used for such purposes. The Board of Governors of the Federal Reserve System to have the right to determine or define the character of the paper thus eligible for discount within the meaning of this act. So when they tell you, oh, we don't accept promissory notes, then that just means that the form more than likely was incorrect, right? Because they're playing the paper game, right? So all you have to do, right, and I make that in my last couple of videos, right? If you go back and check it, right, I talk about bills of exchange and actually the discharge video, right? I'll talk about bills of exchange. So you already see right here the Bill of Exchange Act. This is what they're going by. This is how they operate when it comes to bills, right? That's also in India. In India, they operate the same way. You understand? So this is very important when you're dealing with promissory notes, because every time you get a house or you get a loan for a car, right, they're dealing with promissory notes. Okay, so I'm gonna read a little part of this piece so you get a clear understanding, right? So this is very important to read, right? But you have to also read study the UCC to go along that, because UCC governs the United States Code, right? Because you still have to deal with contracts in order to use these negotiable instruments or bills of exchange. You understand? That's why I told somebody that they said all the dollars are about to crash, but the whole thing is, if you go buy a house, you're not going in the bank with Federal Reserve notes. You're using a promissory note, right? And even if you use deposited funds, you're going to transfer the money, right, through computer entries, right? So it really doesn't really make a difference. Really just use Federal Reserve notes to discharge private and public debts, right? For small debts. Because when you're discharging, no bill collector really accepts cash, right? You can't send cash in the mail. We all know that. It's either check or money order. You also have to study what a check and a money order is. That tells you in the bills of exchange, right? So you need to check that understand, so you know how to operate when it comes to paper, okay? Okay, I'm going to read this. It continues to be the opinion of the board that borrowing for the purpose of purchasing goods is borrowing for a commercial purpose, whether the borrower intends to use the goods himself or to resell them. Hence, loans made to enable consumers to purchase automobiles or other goods should be included under commercial, agricultural, and industrial paper within the meaning of the Federal Reserve Act, and as such are eligible for discounting with the Federal Reserve banks and as securities for advances from the Federal Reserve Bank under Section 13, Paragraph A of the Federal Reserve Act, as long as they conform to the requirements with respect to maturity and other matters. This applies equally to loans made directly by banks to consumers and to paper accepted by banks from dealers or finance companies. So I talk about acceptance, right? So when you send a bill, they're making a presentment so you can accept the paper that they sent you. You understand? And also, when they talk about discounts, you see that's the reason why they talk about the OIDs, original issue discounts. When they get the loans, these promissory notes, they make a claim on it with original issue discount, right? Because the minute that they file it and they make the note public, right, you have a right to that original issue discount, because when they file it in the public registry, right, they have made a private document, right. When you sit at the office at the bank or an auto dealer, you make that private contract, and then they file that contract with the public and make claim against the note, right. Hence, that's why smart people automatically use the OID, right? But that's another video, okay? But you see how it talks about accepted by banks from dealers or finance companies, right? So they're accepting paper. They're accepting and returning for discharge, right? It also applies to notes of finance companies themselves, as long as the proceeds of such notes are used to finance the purchase of consumer goods or for other purposes which are eligible within the meaning of the Federal Reserve Act. So you need to study the Federal Reserve Act also. If there's any question as to whether the proceeds of a note of a finance company have been or to be used for a commercial, agricultural, or industrial purpose, a financial statement of the finance company reflecting an excess of notes receivables which appear eligible for discount without regard to maturity over total current liabilities may be taken as an indication of eligibility. Where the information is lacking as to whether direct consumer loans by a finance company are for eligible purposes, it may be assumed that 50% of such loans are notes receivable, which appears eligible for discount. So notes of receivables are basically debts that are owed to you, right? And notes payable is a debt that you owe out to creditors, right? So on your balance sheets you have notes payable and notes receivables, right? You understand? So let's say like if a seller gives you, you give a seller a promissory note, that's going to be a notes payable. And they're going to hold the note, right? And they release the note when the debt is paid. This is something to know. Okay. The principle stated above does not only to notes of a finance company engaged in making financial loans, but also to notes of a finance company engaged in making loans for other eligible purposes, including business and agricultural loans. Under Section 13A of the Federal Reserve Act, paper representing loans to finance the production, marketing, and carrying of agricultural products, or the breeding, raising, fattening, or marketing of livestock is eligible for discount if the paper has a maturity of not exceeding 9 months. Right? They have a right to the discount. All right, but see, in commercial transactions, commercial papers, any paper that you put in the market, right, that has to be paid in less than 12 months. You know, short-term loans, commercial paper they call it. Basic commercial promissory notes is what they are, right? You just have to know where to file it, right? That's also another video, okay? Consequently, a note of a finance company, the proceeds of which are used by it to make loans for such purposes, is eligible for discount or as a security for a Federal Reserve advance. And such note, unlike the note of a finance company making consumer loans, may have a maturity of up to 9 months. All right, so the whole thing, this is the secret, right? Not secret, but some people know. See, when you sign a promissory note, that's why you got to read everything you sign. It says promissory note on it. You sign a promissory note at a bank or a financial company, right? They take the note to the Federal Reserve window, right, and they get an advance for it. You see that? Consequently, a note of a finance company, the proceeds which are used by it to make loans for such purposes, is eligible for discount or as security for a Federal Reserve advance. And such a note, unlike the note of a finance company making consumer loans, may have a maturity of up to 9 months. So they're telling you right there that they're cashing in on that promissory note. They're taking it right to the window. They have access. right? They plugged in, right? That's why when you discharge, you unplug, right? But sometimes if you want to stay plugged in and you want to stay charged, you don't fully you keep the account revolving, right? You discharge, right, over the amount, so you keep the account going, right? It's basically telling you right here they're cashing in on your proceeds, right? That's why the banking game is a sweet game, right? The bankers, they go to school for commercial paper, right? Negotiable instruments, and they study the Bill of Exchange Act, which is very important if you want to understand negotiable instruments, right? So they're basically taking that paper, they're cashing it in, right? And they're getting the money, right? They're taking that money, right? Even though you got the credit and you're paying on it, you're paying, but they have the money that they had also loaned you, right? For every debit, there's a credit, right? So they gave you the credit, took that promissory note, right, and got their own credit for it, while you're still paying on the note. They got their money out the deal already. But guess what? Guess what they do with that money, though? That profit they just made off of you, right, from that promissory note. Under the fractional reserve system, they're able to loan out 10 times of the amount that they have on hand, right? So let's say you signed a $100,000 promissory note, right? They're able to get 900,000 fractional reserve, right? So this is how the game is played. We're going to talk more in detail on our Patreon channel. You need to study this act. This is very important, right? This is the game they're playing. They're playing a paper game. They're taking your paper and they're selling it on the open market, right? While you're paying on a debt. That's why they call it a mortgage. It's a debt pledge, right? There's a reason why they call it a debt pledge. You also need to look that up too. We'll talk more in detail on that. This is UCC Talk 24. Like and subscribe if you have received value out of this video. Okay.